Daily Fiscal Pulse for the 20th of July, 2026. Just a heads up, we're looking in the rear view mirror here, not watching live action. All of this reflects conditions through the close on Monday. Let's start with what's capturing market attention. The Iran and Middle East conflict is dominating the narrative right now. You're seeing headlines like bets against SpaceX grow to 32% of float as Elon Musk warns short sellers won't survive. And that's clearly influencing how traders are positioned. But the real test is what the actual capital flows reveal beneath the headlines. So here's what jumped out in today's fiscal data. The net transfer came in at $12.9 billion. That number alone looks reasonable on the surface. The real concern though is the trend over the past 5 days, which has dropped to roughly half of what we saw in prior weeks. Tax receipts stepped up at $27.9 billion. Functioning as the primary engine. This is showing up in the equity futures markets as well. ES wrapped the day at 7,486, still sitting beneath the 20-day moving average which sits at 7,528. Over the past 20 days, we're looking at a range of about 267 points, and that range is pointing downward. So the message from flows and price is actually aligned here. Now look at the longer arc. Daily government spending has compressed to around $5.0 billion averaged over the last 5 days. Stack that against the 20-day average of approximately $13.7 billion, and you're looking at a meaningful deceleration. What this translates to in real terms is less cash circulating through the economy, which ultimately affects how much money finds its way into assets. Tighter financial conditions as a consequence. The year-over-year comparison doesn't paint a different picture. Spending is holding steady at roughly $1,290.8 billion. There's no meaningful boost in fiscal support showing up in the data. If you're holding long positions, the fiscal environment deserves honest attention. The current setup isn't exactly a tailwind. Our financial conditions gauge is reading -77. That said, history matters here. We've encountered similar scenarios multiple times, and even when liquidity softens, the S&P 500 has averaged around positive 1.5% over the subsequent month. Price doesn't always move in lockstep with liquidity. It frequently grinds upward regardless. There's also a leverage dimension to consider. Leveraged funds continue accumulating long exposure while margin debt has climbed to the 100th percentile. That's worth flagging as a warning indicator rather than a bullish one. Here's the practical implication. Since fiscal flows are trailing last year's pace, the shock absorber in the system has weakened. When news breaks favorably, equities can still edge higher, but when a risk event emerges, like escalating tensions in the Iran and Middle East region, downward moves can happen quickly, because there's less liquidity underneath to cushion the fall. A couple of calendar items to monitor. The 22nd of July brings the SSA payment cycle, which falls on the 4th Wednesday, and that typically shuffles the near-term flow picture. The subsequent major Treasury coupon interest payment lands around the 15th of August. Look, fiscal headwinds are definitely in the data. What's potentially shifting is the pace of that tightening may be stabilizing. Where things go next probably hinges on how these scheduled payments actually land in the system. That's where the edge sits right now.